Gold just crossed $5,000 an ounce. Let that sink in for a second. A year ago, it was sitting around $2,600. 2 years ago, most Wall Street analysts thought $3,000 was a stretch. Today, it's trading above $5,200. JP Morgan has a year-end target of $6,300, and Bank of America just raised their 12-month call to $6,000. So what's happening? Is this a bubble? A panic? A once-in-a-generation structural shift in how the world thinks about money? The answer, and I want to be honest with you here, is all three, depending on which part of the story you're looking at. Today, we're going to break down every single driver behind gold's historic run: the geopolitical pressure, the central bank revolution, the dollar story, the inflation paradox, and yes, the risks that could bring it all crashing down. By the end of this video, you'll know exactly why investors are buying gold right now, and whether you should be one of them. Let's go. Let's start with the raw performance, because it's genuinely extraordinary. Gold surged over 60% in 2025 alone, and is up more than 18% in 2026. To put that in context, the S&P 500 gained about 16% in all of 2025. Gold nearly quadrupled that return. Gold has been the best performing major asset class over the past 2 years, nearly doubling the returns of the S&P 500 over the trailing 12 months. The move above $5,000 on January 26th unleashed a wave of speculative buying, pushing gold to an intraday high of $5,595. By January 29th, that's a move that shocked even the most committed gold bulls. On February 2nd, JP Morgan raised its gold price target to $6,300 per ounce by year-end 2026. Wells Fargo also lifted its year-end target to between $6,100 and $6,300 an ounce, citing strong central bank buying, policy uncertainty, and other structural demand drivers. Bank of America reset its 12-month gold price target to $6,000 per ounce, with analysts citing policy uncertainty around Federal Reserve leadership, persistent fiscal deficits, and structurally low investor allocations as the three pillars behind the call. This is not a fringe trade anymore. The world's largest financial institutions are revising their targets upward in real time. So let's understand why. The most visible and immediate driver of gold's surge is what traders call the fear premium, the extra price investors are willing to pay simply because the world feels unstable. In February 2026, gold's momentum accelerated following coordinated military strikes in the Middle East and the effective closure of major shipping lanes. This geopolitical risk premium has added an estimated $800 to the price of an ounce. Analysts at JP Morgan noted that conflict-driven surges in gold come and go, though geopolitical risks broadly are likely to stay on the boil, which partly contributes to their forecast of gold reaching $6,300 by end of 2026. As one certified financial planner put it, as long as we still see global upheaval, I think gold will continue to do well. But here's the important nuance. Geopolitical fear alone doesn't sustain a multi-year bull market. The 2022 Russia-Ukraine invasion caused a brief spike, and then gold gave back much of those gains. What's different now is that the fear premium is layered on top of a set of deep structural forces that were already moving gold higher before any single geopolitical event. The geopolitics accelerated a trend. They didn't create it. Geopolitical and economic uncertainty was the most visible catalyst behind gold's rise in 2025. Developments such as trade tariffs and ongoing conflicts in the Middle East and Ukraine heightened risk aversion and reinforced gold's role as portfolio insurance. The fear trade is real, but it's the foundation beneath it that explains why gold isn't pulling back the way it has after previous spikes. This is the story that most retail investors miss entirely, and it's arguably the most important driver of gold's structural bull market. Central banks added over 4,000 metric tons of gold to their reserves since 2022, creating a strong floor for the metal's price. To understand what that number means, it represents the largest and most sustained period of central bank gold buying in modern history, more aggressive even than the buying sprees that followed the 2008 financial crisis. JP Morgan projects central bank and investor demand for gold to average around 585 tons a quarter in 2000-2006. Why are central banks doing this? The answer is de-dollarization, the systematic reduction of dependence on the US dollar and US treasuries as reserve assets. Geopolitical shifts and de-dollarization are driving diversification, with China, India, and Japan leading the trend. China's plan to serve as custodian for foreign sovereign gold reserves could spur new central bank buying from emerging markets. The seizure of Russian foreign exchange reserves in 22 sent a message to every central bank in the world. Gold, by contrast, is nobody's liability. It cannot be frozen. It cannot be sanctioned. Central banks in places like China and India aren't simply adding gold as backup. They're swapping it into their core holdings instead of dollars. In Q4 2025 alone, retail-focused ETFs experienced inflows equivalent to over 280 tons in gold purchases. When central banks and retail investors are both buying simultaneously, the demand curve shifts, and it doesn't shift back quickly. You cannot understand gold in 2026 without understanding what's happening to the US dollar. And what's happening to the dollar is significant. The US dollar's rapid decline, driven by de-dollarization efforts, strengthening foreign currencies, and mounting debt, has been compounded by a Moody's credit rating downgrade that eliminated the country's final unvarnished credit score. The Supreme Court's decision limiting tariff authority has led investors to reassess the federal government's revenue outlook. If tariff-related income declines in 2026, the Treasury likely will need to issue more debt to cover the gap, increasing supply at the long end of the curve. This policy mismatch, tightening from the long end and easing from the short end, could push the Fed to lower rates more aggressively to stabilize financial conditions. Such an environment tends to weaken real yields, reinforcing gold's role as a store of value. Here's why this matters for gold. Specifically, gold is priced globally in US dollars. When the dollar weakens, gold becomes cheaper for every buyer outside the United States, which mechanically increases global demand and pushes the dollar price of gold higher. A weaker dollar, all else equal, raises gold prices and enhances the returns of non-US investors in their local currencies, creating a self-reinforcing demand cycle. Even with the Federal Reserve holding rates in the 3.5 to 3.75% range, which historically would pressure gold, gold has shattered the $5,000 barrier and is trading near $5,395. This surge marks a paradigm shift in investor behavior, where the fear trade and the inflation trade have merged to overwhelm the traditional yield trade. Investors are no longer prioritizing the yield on cash. They are fleeing to gold as a shield against a stagflationary horizon. This is the part of the story that breaks the old models. Conventional finance theory says gold should struggle when real interest rates are high. Gold is not yielding anything. So if you can get 4% on a treasury, why hold gold? The answer in 2026 is that confidence in the system backing those treasuries is the variable that's changed. When that confidence erodes, gold's lack of yield becomes irrelevant. The newest and most acute pressure on gold came from tariff policy, and the market's reaction was immediate. Gold prices jumped in late February as tariff fears returned. When the US Supreme Court rejected fast-track tariff powers, the president pushed back, hiking import taxes worldwide to 15%. That move rattled investors everywhere and was quickly named the tariff trap in financial media. The 15% tariff regime sparked fears of a global trade war reminiscent of the protectionist eras of the 1930s. As nations move to protect their domestic industries, the efficiency of global supply chains is being dismantled, ensuring that inflation remains sticky, regardless of how high the Federal Reserve keeps interest rates. This systemic shift toward protectionism is a primary reason why analysts believe the current gold rally is not a bubble, but a structural repricing of risk. The specific fear here is stagflation, the combination of slowing economic growth and persistent inflation. It is the worst possible macroeconomic environment for traditional assets. Stocks fall because earnings growth is weak. Bonds fall because inflation erodes their fixed payments. Cash loses purchasing power. Gold, historically, is one of the few assets that performs in stagflationary environments, which is exactly what the 1970s demonstrated during gold's last great bull market. The World Gold Council notes that the concerning mismatch between the level of conviction in the outlook versus the economic policy uncertainty currently on display is one of the key reasons gold had its best year since the 1970s and continues to do well year to date. Investors aren't just hedging inflation, they're hedging the risk that policymakers will make the situation worse, either by cutting rates prematurely and reigniting inflation, or by keeping rates too high and triggering a recession. In that environment, gold is the asset that doesn't depend on any policy decision going right. This channel doesn't do one-sided analysis, so let's be honest about the risks, because they are real. The CEO of the de Group warned investors to approach gold with caution, identifying several material downside risks to the gold price. One significant risk: central banks could begin unloading their reserves. As he noted, gold remains one of the few unleveraged sovereign assets for governments under political or financial strain. The temptation to liquidate reserves is real. HSBC's James Steele warned that easing trade tensions or any fiscal consolidation could relieve some of gold's risk premium and trigger a sharp pullback, with the bank forecasting a wide 2026 trading range of $3,950 to $5,050. A January analysis by the Financial Times showed a consensus price target among 11 strategists of just $4,600 per troy ounce by year-end, already well below current prices. With Macquarie Group warning that gold is becoming increasingly unpredictable because its trajectory is now being steered as much by speculation as fundamentals. The honest summary of the risk picture: gold is overbought in the short term by almost every technical measure. A geopolitical détente, a genuine fiscal consolidation plan, or a surprise Fed hawkishness could trigger a sharp pullback. Investors who buy at $5,200 because of FOMO, fear of missing out, without understanding what they own and why, will be the ones who panic sell in a 20% correction. Here's the framework that actually matters. Gold's strategic role remains as relevant as ever. Its historical ability to provide diversification, mitigate drawdowns during periods of market stress, and perform even after strong run-ups reinforces its value as a core long-term portfolio component. The structural bull case: central bank buying, de-dollarization, dollar weakness, stagflation risk, fiscal deterioration, is intact and is not a story that resolves in the next 6 months. These are decade-long forces. If you plan to invest in gold, financial advisors broadly agree it should be a small but deliberate slice of your investment portfolio, not a concentrated bet. The standard recommendation has moved from the traditional 5% allocation toward 10 to 15% for investors with genuine macro hedging goals. How to access it: the SPDR Gold Shares ETF, GLD, offers low-cost exposure with an expense ratio of 0.4%, far lower than the costs of storing and insuring physical gold, and mirrors the price with a near-identical performance profile. The Motley Fool gold mining stocks offer leveraged exposure, higher upside, and higher volatility. Physical bullion offers direct ownership but comes with storage, insurance, and liquidity considerations. As one CIO put it, there was logic in having an allocation to gold, a commodity with a 5,000-year track record, particularly through periods of uncertainty. The bottom line: gold at $5,200 is not cheap, but the forces driving it higher are structural, not speculative. Understand what you're buying, size the position appropriately, and hold it as insurance, not as a lottery ticket. If this gave you a clearer picture of what's really driving gold right now, hit like and subscribe. We break down exactly this kind of real-world market analysis every week. Drop a comment. Are you holding gold? What percentage of your portfolio? I want to hear from you. See you in the next one.